So if you're looking at a real estate deal or investment, you probably run into one of these three or all three of these return metrics: cash on cash return, the equity multiple, and the IRR, or the internal rate of return. Now, in today's video, I'm going to talk about what are those three return metrics. I'm going to break down, what they are, how to use them, and what the limitations of each are. My name is Sita Nabuya. I'm a commercial real estate consultant and multifamily investor, and I'm going to break down these topics in today's video. Let's get into it. So up first is going to be the cash on cash return. Now, this one is one of the most straightforward and simplest ones. So a lot of times when people say return on investment, a lot of times what they're saying is the cash on cash return. That's going to be the percentage return of the actual cash invested. So, for example, let's say you invest $100,000 into an investment over the course of several years. That return or that cash flow is going to give you $10,000 per year on average. So in that case, the average cash on cash return is going to be 10,000 over 100,000, which is going to be 10%, which is a pretty good cash on cash return. Now, this return metric is going to be great for understanding the cash flow. So, like, what is the asset actually producing in terms of cash flow? What is it paying you on a regular basis? Now, what it doesn't take into account the appreciation or the value add. So, that's one limitation of this particular return metric. The second return metric is going to be the equity multiple. Now, that just tells you how much you, as the investor, your capital is growing over time. And it's typically going to be expressed in the form of blank X. So the formula is going to be your total distributions, which include both the cash flow, the amount of money that you're getting regularly from rents, and then it's also going to include the sales proceeds. So what are you making once you actually exit, either through sale or refinance, and you increase the value, you're able to sell and get a big windfall of capital. You take both of those together and you divide it by your initial capital invested. That's going to be your equity multiple. So if you're looking at an example, let's say the total distributions are going to be $100,000 in cash flow and then $100,000 in your sales proceeds over an initial $100,000 investment. That's going to be an equity multiple of 2x, meaning you doubled your money with this investment. Now, the benefit of this is that it shows you the amount of appreciation. It shows you that value add and it characterizes that. As I mentioned, you're able to double your money in, however long, which is, can be pretty good depending on the timeline. But that's also the limitation is that it doesn't factor in the time because doubling your money in 2 years versus 10 years is two completely different investments. Now I'm going to cover one more return metric, but before I get into that, if you got some value out of this video so far, please go ahead and like and subscribe and be on the lookout for more videos. Lastly, the internal rate of return, commonly referred to as the IRR, is going to be a little more complex than the previous two, but it's also going to be one of the most common return metrics used to evaluate assets. Now, essentially, it's the annualized return on investment over time, factoring in both cash flow and appreciation. Now, to calculate the IRR, is the discount rate at which the net present value of an investment is equal to zero. You probably don't know what that means, and that's okay because most of the time you're not really going to calculate the IRR by hand. A lot of times it's going to be calculated in Excel using the IRR or more commonly the XIRR function. All right, now here's an example in Excel. So in this example, you have the dates and you have the values. So these dates represent the time or the periods of the distributions. And then the values are going to be the distributions themselves. So you can see initially start off with an investment. You put in $100,000. That's why it's negative because you're losing $100,000 by putting into the investment. And then all of the periods after that, you're seeing the cash flow or the distributions from that investment, and at the end there's an exit and you're making a much bigger cash flow. So the XIR function takes in both those dates and it takes in those values or those distributions, and then it's going to calculate the internal rate of return. And here the example is 20.23%, which is a pretty good IRR for most typical real estate deals. Now the IRR is very commonly used because it allows you to calculate a return by factoring in the time value of money. So as I mentioned, you have the dates and the distributions. The IRR is going to be higher if you get more cash flow earlier in the investment process. Now, this is important because a dollar today or a dollar returned tomorrow is more valuable than a dollar returned a year from now. Because theoretically, you can take that dollar and then invest it in something else that's a cash flow asset and gets you more returns. So, being able to get a return quicker or getting capital faster from an investment is going to be more advantageous, and the IRR calculates for that. Now, this can be helpful when you're trying to assess or evaluate different investment opportunities that have a different time horizon. You may have an investment that's going to return your money in 2 years or 3 years versus another one that's going to return it in 7 or 8 or 9 years. Now, whether or not one is going to be better for you than the other may be tough to tell depending on your situation. But at least with the IRR, you can say what is going to be more valuable based on returns and then the timeline in which you get those funds back. So, a project that's going to return your money in 10 years must have a much higher value or much higher return distribution than a project that's going to get you your money back in 2 to 3 years. So the IRR allows you to account for that and gives you an apples to apples comparison even on projects with different time horizons. So in conclusion, all of these return metrics are good and they're valuable, but they're all incomplete. And that's why you're going to see, for the most part, investors are going to use a combination of the three or all three to be able to qualify and invest and evaluate an asset. So one by itself won't give you the whole picture, but if you look at all three and even other return metrics, that's going to give you a more comprehensive look at whether or not an investment is a good opportunity for you to invest in. Now, if you got some value from this video, please go ahead and like, subscribe, be on the lookout for more, and please leave in the comments any other things that you want me to cover or go over, or even if you have any questions about what I talked about today. Thank you.